All right, let's talk about something that trips up a ton of real estate investors: owning a rental property in a state where you don't actually live. It seems simple enough, right? But it comes with this whole tangled web of hidden tax rules that can get you into a lot of trouble. So let's dive in and pull this apart.
So you've got that condo down in Florida or that duplex out in Arizona. From your desk, it probably just looks like another line item on your spreadsheet, a passive investment. But you know what? To the tax agency in that state, it is anything but passive. It's an anchor. And that anchor has some serious weight you need to know about.
And that's really the big idea for today. The second you buy property in a state, you are legally tethered to that state's tax department. It doesn't matter where you live. It doesn't matter where you cash the rent checks. The physical location of that building creates an unbreakable link, and that link means you're on their radar.
So, here's our game plan. We're going to talk about this invisible tax tether and the #1 rule of sourcing. Then we'll get into how states are using technology, this digital dragnet, to find people who aren't paying. We'll look at the scary, infinite liability that creates. But don't worry, we'll end with the solution: how to get compliant and what you need to walk away with today. Okay, so first things first, let's talk about why states can even do this. It's pretty simple, really. A state's right to tax income from property inside its own borders is absolute. I mean, think about it. That property uses state services, right? Police, fire, roads, courts. So it only makes sense that the income it generates is tied to that location.
And this right here is the magic word you have to remember: sourcing. This is the whole ball game. See, unlike your stock portfolio, which is usually taxed where you live, income from real estate is always sourced to its physical location. This gives the source state first dibs on taxing every single dollar of profit that property makes.
Now, this is where it starts to get complicated. You've got these two competing claims. On one side, the state where the property is located says, hey, that's our income to tax. But then your home state says, hold on, we tax all of your income from everywhere in the world. This creates a dual tax situation, and the only way to fix it is with a system of tax credits to make sure you're not paying tax twice on the same money. And trust me, that credit system can be a trap.
So what do they get to tax? Well, it's way more than just the net profit from rent. Of course it includes that, and the capital gains when you eventually sell, but it also includes things that catch so many investors by surprise. Like, say you sell a California property on an installment sale. You have to keep filing a California non-resident return, that's a Form 540-NR, for every single year you get a payment, even if you now live 1,000 miles away. And don't even get me started on the 1031 exchange clawback rules, where they can tax a deferred gain years down the road.
Right about now, you're probably thinking, okay, but how would they ever know? Well, listen, the days of flying under the radar are over. States have built these really slick automated systems to hunt down non-resident owners who aren't filing. Let's peel back the curtain on how this digital dragnet actually works.
The scary part is that this is all on autopilot. It starts with public records. The state's computer scans property deeds and flags every single one with an out-of-state mailing address. Then it asks a simple question: did this owner file a non-resident tax return with us? If the answer is no, boom, an audit letter gets printed and mailed automatically. They'll even look at your homestead exemption in your home state as proof that the other property is an investment.
And it's not just deeds. Your own property manager is sending a signal. They have to send you a Form 1099 MISC if they collect over $600 in rent. And guess what? The IRS shares that data with the states. So the state sees a 1099 from a local property manager paid to an out-of-state owner, and if they don't see a corresponding tax return, it's an instant red flag. It all creates this web of data that points right to you.
Okay, so they can find you. Now what? What happens if you've been skipping out on filing? This is where things get really serious, because the financial hit for non-residents is often way bigger than it is for residents. Let's break down exactly what that looks like.
Let's just use California as an example. Their law says your property manager has to withhold 7% of your gross rent and send it straight to the state. Notice I said gross, not net profit. 7% of your total revenue. If you have a mortgage and high expenses, that could be a huge chunk of your cash flow gone, unless you know to file for a waiver with their special forms, like the 588 or 589.
And if you think 7% is bad, check this out. For foreign investors, what the IRS calls non-resident aliens, the default federal rule is a whopping 30% withholding on gross rent. Again, no deductions. On a property with tight margins, that could literally be more than your entire profit. The only way around it is to make a special election under IRS Code 871D to be taxed on your net income instead.
All right, now for that tax credit trap I mentioned. Most of the time, the logic is pretty simple. You pay tax to the state where the property is, and then your home state gives you a credit. But a handful of states, California, Arizona, Oregon, and Virginia are the big ones, do it completely backwards. It's called a reverse credit. So if you live in California and have a rental in Oregon, you pay California first, then you have to ask Oregon for the credit. You get that wrong, you could end up paying full tax to both states. Ouch.
This is maybe the single most important and frankly terrifying concept in this whole discussion. Usually, a state only has a few years to audit you, but that clock doesn't start ticking until you file a tax return. So if you never file, the statute of limitations never starts, ever. This means they can go back 10, 15, 20 years and hit you with a bill for all of it, plus penalties and years of compounding interest.
Okay, so after all that doom and gloom, you might be wondering if there's any good news. And there is. If you realize you haven't been compliant, there's a formal way to come clean and fix it. It's called a Voluntary Disclosure Program.
Think of a VDP as a kind of settlement offer from the state. The deal's basically this. You come to them first, before they find you, and you agree to pay the back taxes for a few years. In return, the state agrees to waive the big penalties and, most importantly, they agree to forget about all those other years you didn't file. And the benefits here are just huge. The limited look-back is the grand prize. Instead of a 20-year liability, suddenly you're only looking at maybe 3 to 6 years. They usually waive the huge failure to file penalties. But here's the catch, and it's a big one. You are only eligible if you haven't been contacted by the state yet. The second you get that letter in the mail, this option is off the table. Now, some people get tempted to try something called a quiet filing. That's where you just start filing this year's tax return and hope for the best. This is a massive gamble, because when that new return hits their system, it often triggers an alert that asks, hey, where are the last 15 years of returns? A VDP, on the other hand, is a formal legal agreement. It gives you certainty and closes the book on the past for good.
All right, we have covered a lot of ground here, from sourcing and audits all the way to VDPs. So let's just boil this all down into the key things you absolutely have to take away from this.
Okay, number 1. Source always beats residence. You have to file a non-resident return in the state where the property sits, period. 2. Know your credit rules. If you're dealing with a reverse credit state like California, Arizona, Oregon, or Virginia, get it right or you'll pay twice. 3. Get ahead of withholding. Make sure your property manager has the right waiver forms on file. And 4. The most important rule of all. If you have a problem, act first. Get into a voluntary disclosure program before their computer finds you.
So I'll just leave you with this final thought. That property is supposed to be an asset, right? Something that builds your wealth. But if you're not careful, without the right tax compliance, that asset could be hiding a ticking time bomb. A hidden liability that, remember, never ever expires. Thanks for watching.